I think many of us believe that the top investors only win. Warren Buffett, Cathie Wood, Peter Lynch, Bill Ackman, Ray Dalio, do they only make money? No. So in this video, I'm going to tell you exactly how these investors operate and how do they handle the psychology of losses. And you'll be surprised to know that the top investors in the world suffer brutal drawdowns, okay? And I want to distinguish here between a drawdown and a loss. Drawdown means that your portfolio went down by, in the case of many of these investors, 50 to 70, 80%, but it's not necessarily a loss. A loss is only a loss when you press the sell button, right? And over the long term, these investors are extremely successful. My name is Henry. I've been investing for the last 20 years and I'm the CIO of Maverick Capital, a fund based in Hong Kong. And let's talk about how legendary investors endure brutal drawdowns. Okay, so the most important thing is that success requires sticking to your investment strategy and have the discipline to stomach volatility. Markets are volatile, okay? But volatility is not exactly the same as risk, okay? One of my students recently came to me asking me if he should sell all his stocks because of the Iran conflict. There is a lot of volatility in the market. And I asked him, do you need the money now? Do you need the money to make any big payment, a house down payment, or a car, or medical expenses? And his answer was no. He doesn't foresee to use this money, to need to use this money. So I told him, of course, just hold for the very long term. Because if you need the money in the short term and tomorrow the market crashes by 30%, it's painful, of course, because now you need to sell at a 30% loss in order to, to use the money to whatever you need. But if you can wait, markets always recover, okay? As I've been showing you over and over, markets, the stock market, the American stock market, S&P 500, NASDAQ, over prolonged periods of time, over any 10-year period, pretty much only goes up, okay? But of course, in the meantime, you'll have volatility. You'll have market crashes. You have drawdowns of 20, 30, 40%. But if you stick to your investment strategy, if you have the stomach to handle that volatility and not panic sell, understand that volatility is not the enemy, but opportunity to buy at cheaper prices, you will perform very well. Okay, so let's see how these investors deal with volatility. Warren Buffett said that the stock market is a machine to transfer money from the impatient to the patient. Patient investors make money. And Warren Buffett has been extremely patient. Did you know that Warren Buffett suffered multiple 50% drawdowns? Yes, one of the richest people in the world suffered several 50% drawdowns. Imagine your wealth, your portfolio going down by 50%, and you are still the richest person in the world. And he also said that you should look at market fluctuations as your friend rather than your enemy and profit from them rather than participate in them, right? He also said be fearful when everyone is greedy and be greedy when everyone is fearful. When everyone is panic selling, that's probably a good time to scoop up good quality companies, good quality stocks at a discount. And Ray Dalio, another great investor, one of the best investors of all time, from the Bridgewater Associates, one of the very big $1 trillion fund, experienced several 20% drawdowns, okay? So if these people are suffering these drawdowns, who am I to panic and sell when there is a little market correction or market crash, right? Cathie Wood from ARK Invest. In 2021, her flagship fund, the ARK-K ETF, declined by 80%. Can you imagine that? 80%. And she is still a very, very successful asset manager and fund manager. She was not shaken up. She didn't have weak hands, continues to believe in the long-term strategy of the ARK Invest funds, and it will perform very, very well. Bill Ackman, another great investor, suffered a drawdown of 57% between 2015 and 2018. plus multiple 20 to 30% drawdowns. But still, his annualized return on investment is higher than the S&P 500. And again, Bill Ackman, one of the best investors of all time. Imagine that people give up when they have their first 50% drawdown. Imagine your portfolio declined by 50%. You say, I'm done. I don't want to invest more. And you get out of the stock market and you sit in cash. Cash always melts away because of inflation. And maybe you could be the next Bill Ackman, right? If you have the psychology to just hold throughout volatility, hold for the long term, and let the market figure it out, and perhaps even benefit from the volatility. Peter Lynch, one of my favorite investors, he suffered again multiple 20 to 30% drawdowns. Peter Lynch said that far more money has been lost by investors trying to prepare for market corrections than the market corrections themselves, right? Because if you're trying to prepare for the market correction, maybe you sell, you wait for the market correction, maybe the market correction never happens, and then when it happens, you don't know when to enter back in the market. So that's a recipe for disaster. And Peter Lynch also said that his fund, the Magellan Fund, has most times had bigger drawdowns than the market itself. So usually the benchmark for this kind of stuff is the S&P 500, and the Magellan Fund had bigger drawdowns every time there was a market crash. His fund crashed more than the stock market, than the S&P 500. He's still around, still one of the best investors of all time. Okay, so what are the lessons that you can take from this? I have 5 lessons for you. First one, of course, volatility is not the same as risk. Volatility is risk in the short term, but performance in the long term. If I need the money next month and I'm invested and there is a volatility and the market drops by 20%, that's bad, okay? So if I need the money in the short term, maybe I should be investing in volatile assets like stocks. But in the long term, volatility is good because volatile markets usually perform better. And also when there is downside volatility, you can always use that opportunity to buy the dip, to do some dollar cost averaging and use this opportunity to buy cheaper and let the market recover and have very good gains. Second, you need to master loss aversion bias. Usually losses are more painful than gains. There is some papers that say that losses are twice as painful as gains. People don't like to lose money, okay? Do you prefer to lose $20 or win $30? Most people prefer not to lose $20, right? But you need to look at risk-reward ratios. You need to look at expected value. Are you going to have an expected value from this bet or not? And just forget your loss aversion bias. Third, time in the market beats timing the market. These investors that I talk about in this video, they are not trying to time the market. They are very long-term investors. They work always on multi-year investment timeframes. They are not traders. They are not short-term traders. If you name the biggest investors of all time, they are all long-term investors. Tell me one investor that is a day trader. A successful. Tell me a billionaire that is a day trader. I'm pretty sure you have a hard time to do it. But I can name you from the top of my head 5 or 10 billionaires that are long-term investors. Fourth, build an investment strategy that you can replicate again and again. You need to have an investment strategy. You need to do deep research and have a framework that you can repeat again and again. You need to have your investment thesis and stick to it. Because if you don't have a solid investment strategy, once there is a market crash, you'll panic sell. Weekends, right? But if you have a good, solid investment strategy that you back tested, that you tested, that other people have used, you will be able to stick throughout the bottoms of the market and take advantage of them. And this is what I teach in my community, the Henrique Wealth Academy. Check the link in the description where I talk everything about investment psychology, my stock picks, my ETF picks, and so on and so on. Fifth and finally, drawdowns create opportunity. Market drawdowns are opportunity if you are a long-term investor. Every time the market drops, just like it did recently because of the Iran conflict, I'm buying. I buy leverage ETFs, I buy stocks, and they perform extremely well. since I bought during the bottom of the market a month ago, some of these ETFs went up 100%. Can you believe it? If you use these market bottoms, this can really compound over time and give you very, very good returns. So really, the edge is psychological, okay? You need stick to your investment strategy. Don't think of yourself as a loser by having a market drawdown. The market crash is 20% and your portfolio is down 25 or 30%. That's okay. It happens to the best. It happens to the best families, right? It happens to the best investors. Stick to your investment strategy, keep buying, keep holding, and you perform well. All right, if you enjoyed this video, give it a like and subscribe, and I'll see you on the next one.